Good morning and welcome, Wicked Smart listeners. Thanks for joining me again this week. This is Chris Preety, and I hope you're in a spot where you can get to the YouTube video on this episode and not just the audio. If you can do that later, if you can't now, that's great. I think you're going to get a lot more out of the show. My focus again this week is to, in some shape, form, or fashion, empower you because I want you to be able to take action. This is an interesting guest I have coming on. I'm going to introduce him in a minute. And we get to have him on a Wicked Smart sit down coming up here in June. Actually, the date is June 27th. If you're not familiar with the Wicked Smart sit downs, let me just kind of divert a little bit and talk to you about that. Since about 2017 or 18, we have hosted for free for you the Wicked Smart sit down. And those are either going to be conducted by myself, my son Nick, my son-in-law Zach, the coaches, and guests. And our next guest, Mario Dattilo, is going to be a guest on June 27th. And you're not going to want to miss it, guys. Mario owns mobile home parks. He owns self-storage, and he's primarily in the Southeast, Midwest, and Northeast in the Southwest region. But that doesn't matter because what he teaches you can be done anywhere, wherever you are right now. He's got a bunch of other businesses. He's got years of experience, which is why I wanted him on here. You guys know I'm very focused on making sure we bring experience to the table here. He's going to share that with you. He's going to share about what it takes to start and build a profitable real estate portfolio. It's just that he's done it differently than us. And I think it's really cool for you guys always to be exposed to a means of moving your payday 1, 2s, and 3s into other areas of investments in the real estate space. And for those of you that are not in the creative space, then it gives you other options to take a peek at. Now, I can't imagine you not being in the creative space because you can do creative real estate in any asset class, including what we're going to talk about here with Mario. So buckle in here while we bring you the next Wicked Smart Masters class. All right, guys, I want to make sure to remind you about our QLS Live event. We've been hosting this thing since 2016 in a basement, and now we have a brand new facility in Boston, Massachusetts this year, 2024. It's going to be September 23rd and 24th. That's a Monday and a Tuesday. It makes it easy for travel. It is literally right next to the airport. Go to smartrealestatecoach.com/QLS Live and use the coupon code podcast50. That's going to give you 50% off. I'll see you there. All right, Mario, with that as a little backdrop, welcome to the show, my friend.
Hey, Chris, thanks for having me on. I'm excited to do this. Once again, doing something together. It's always fun.
Yeah, and as I just said in the intro, we're going to be hosting you on our Wicked Spot sit down. So these guys are in for a treat. Let's give them a little background then. I guess first and foremost, take them behind the green curtain. How did you end up in the mobile home space? Because I think it's really cool for a lot of reasons, and we'll dive into that.
Yeah, so I didn't intend to be in the mobile home park space growing up. Had no interest actually in real estate because my dad was in construction, and I thought construction was real estate. I ended up in the real estate brokerage and mortgage business going into, call it 2006, 7, and 8. And I ended up running the real estate brokerage with a partner. In 2008, the market, as you know, crashed, and I started helping investors buy single-family homes, flip, and do all that. And I was basically handling their acquisition and their dispo as an agent. So I went to my dad and I said, hey, you know what? This whole brokerage thing is cool, but I think we should be doing what they're doing. We should be buying this stuff, and you handle the construction, I'll handle the acquisitions, dispo, and capital, and that's kind of how we started it. We shut down the brokerage, and my dad and I started pursuing single families. We actually mostly flipped a little bit of wholesaling, but mostly flipped from 2008 to about 2013. And around that time, as you know, the market was a lot less distressed. A lot of that distressed product had gotten eaten up. And we said, you know what? Let's go into some cash flowing properties. And we looked at residential. We looked at, other commercial properties. And we decided that we wanted to go with multifamily. We felt like it was something that we were very comfortable with. It was familiar, compared to single family, and couldn't find a deal. Struggled to find a good deal. And a buddy of mine who is a commercial banker calls me up one day and he goes, hey, look, I know you're looking for apartment buildings, but I think I've got a really sweet deal on a mobile home park in your backyard. It was in Naples, Florida, where I live. And he said, the bank is wanting to sell the note. It's non-performing. Would you consider buying it? And I'd bought a lot of non-performing notes before. And we did our due diligence, and that was kind of the kickoff to buying mobile home parks, and I haven't looked back since. So we've bought a little bit of self-storage as well. We're buying one right now, but for the most part, the focus has been mobile home parks pretty heavy, and it's been an awesome asset class.
Okay, I got a lot to unpack there. That's a really cool story. First of all, you have a lot of parallels to my story with my son. So flip-flop for you and your dad, right? You lived through the '08 lovely debacle, as I call it. If I was to ask you, and we're going to jump into mobile homes, but there's just a couple of things I want to hit there.
Sure.
If I was to ask you the most important, let's call it lesson learned of the '08, what would it be? I know there's probably a 20, but what would one be that the Wicked Smart listeners could glean something from? What do you think?
Yeah, I mean, I watched a lot of friends crash and burn. You know, I was in the brokerage business, so I was really helping people buy and sell.
Right.
I didn't have any ownership in any real estate other than a personal home. But I think the lesson in all that is don't believe the hype, stick to your numbers, pay attention to cash flow and buying things at discounts, and don't chase the market up. You know, I was on a panel last year for the IMN conference, which is a big commercial real estate conference. I was on a panel, and there were 3 institutional investors, and I would call us 2 private investors on the panel. And the 3 institutional investors were saying that they couldn't buy real estate at the end of 2023. They were struggling to find deals, but they had a heyday leading up to that. So the last several years, they were buying like crazy. And myself and the other private investor were like, we couldn't buy anything the last 3 years because the pricing was ridiculous, made no financial sense. And we're finally having a heyday here buying things. And so it just kind of shows you that I have nothing wrong with institutional investors, but the market in general chased cheap money, and they chased the hype of values going up, where we were always trying to buy on value and trying to buy at discounts. And so they're going to be struggling. We're going to be thriving buying things at better prices. So just stick to your fundamentals and don't chase the market up.
I love it. Super cool answer. Question on the first park you bought, the note on. How many units was that one? How many?
It was a 57 site community, and it was in, like I said, Naples, Florida, just a super prime location.
Now, Mario, you also teach this, correct?
I do, yeah. I've got a coaching program all around mobile home park investing. Yeah.
Okay, so we're going to definitely want to make sure that they know how to reach you. And then I can't stress enough for the Wicked Smart listener, if I say it 14 times, it's not enough. You got to come to the Wicked Smart sit down on June 27th, I think it is. And if you want more details on that, just go to smartrealestatecoach.com/events or send an email to support@smartrealestatecoach.com. You're going to be able to dive into a little bit deeper there. We're just touching the surface, Mario and I.
Sure.
So tell me this. You and I, before we went on here, said the word creative came up a couple of times. That's my world. So how do you buy these? Do you buy them all conventionally? Do you buy some creative? Talk about how you structure these a little bit on any front that you want to.
Yeah. I mean, good example to start with would be the first deal that I bought. You know, I had bought that deal as a non-performing loan from a bank, and this is how creative real estate deals can get you into just awesome deals that other people are trying to buy and can't. So on that deal specifically, everybody was trying to buy the property from the owner, and they were trying to do a short sale. Okay. The guy owed $4.2 million roughly on the deal. He had $1.1 million roughly in code enforcement liens. And everybody was going in the front door trying to buy it as a short sale. And as soon as they would get behind the scenes and they'd see, wait, this thing's got a huge $1 million loan with the county, it would kill the deal. So by us going to the bank and negotiating to purchase that non-performing loan, then what we did, we put it under contract. We went to the county, and I got a general contractor that did a lot of work for the county to kind of come in as a consultant and be in that meeting with the county. They pretty much vouched for us, and they said that they would handle the construction aspect of things. And we negotiated with the county that we were going to wipe them out in the foreclosure, because by buying the first lien position and foreclosing, it would actually wipe out their code liens. but we knew that they could come in and just start hitting us with new violations and create a lot of problems. So we put together an agreement with them that said, if you do these things within this period of time, you're on our good side. We're going to leave you alone. We're not going to chase you anymore. And we documented that with them in our due diligence period. And then we ultimately closed on the purchase of the loan. And then we went and foreclosed. Now, get this. We now have title to the property as the title owner. Previous owners wiped out. We went to the previous owner and said, hey, look, we've got this loan that you owe us $3.7 million or something like that. It was over $3 million in a balance that's owed. As a deficiency judgment, we can go after. And we said, why don't you just write us a check and we'll take you off that personal guarantee, won't affect your credit, won't go after you for the judgment. So he then wrote us 3 checks totaling like $135,000 over a 9-month period. So we further reduced our basis in the deal. Okay. We turned that deal around. We ended up selling it for $6.5 million. Our basis was about $625,000 on that deal. So made like $5-point-something million on that deal. But the lesson in that story is you got to think outside the box, and sometimes going a step deeper in the deal and buying the debt or buying a lien. I've done that on, even a condo. I bought a HOA lien, then went and paid off the mortgage because the balance on the mortgage was really low, and got ownership of the property that way. So done loans, bought non-performing loans. We've done a lot of seller financing, probably similar to what you do on single families or other property types, where we get the seller to carry the paper, usually first lien, actually. And the whole pitch on that is tax benefits, right? Because they're not getting this lump sum. A lot of these longtime owners have, they've depreciated the property completely, and they're going to get hit with this major tax, or they've got too much cash coming. They don't know what to do with it. They're old timers. Like, all they know is they just want to retire. They need $2 million to do it. But if they take all that cash, they're not going to get their $2 million. So we then help them out by providing, a first lien to them for carrying the majority of the financing. One other strategy we've used, because I want to talk high level here and you can tell me what you want to go deeper on. We've done subject to on a mobile home park, 120 site community. The seller had, it was a pretty complex deal. We actually bought it on an assignment, formed a trust, kept the in-place Fannie Mae loan, and then we basically took ownership of the property through the trust. And I mean, that's much more complicated with a commercial deal buying subject to than single family, because there's reporting requirements to the lender and all that. But we did a subject to deal with them, refinanced the property out, and ultimately got out of their debt. And so there's some pretty cool things you can do with commercial property that you can do in residential as well.
So 2 questions on 2 different deals. The very first deal, what was your turnaround time on that one, Mario?
So we bought, meaning like how long did we own it?
From buy to sell, yeah.
Yeah, 5 years. We bought it in late 2014. We closed on it December 30th, 2019.
So you averaged $1 million a year in profit. Not too shabby. Yeah. And on that other deal that you bought sub 2, totally get the trust set up. How long did you wait to refi that?
I want to say we owned it for about 4 years, 3.5, 4 years.
So no problems in that 3 or 4 year span, and then you did a refi.
Yeah. So part of the issue was we couldn't do an assumption. You'd say, well, Fannie Mae is an assumable loan. Well, we couldn't because they had defaulted on the loan previously and had done a workout. So the loan was a scratch and dent loan, and the lender wasn't going to do any sort of assumption on it. So yeah, we had to basically buy it sub 2. And then what we did is we added myself as an additional contact for the loan. So I can call and get any information that I needed about the loan directly. And then one challenge that we did have on that deal is the seller was the guarantor on the loan, was supposed to be providing financials each year to submit to the bank, because that's pretty common, either quarterly or annual financial reporting to a lender, and he wasn't. And thankfully, we were able to buy us enough time to just kind of keep kicking the can down the road. We always provided the property financials, but always blamed the borrower and just said, hey, you know what? He's being difficult. His financials are behind. And they believed it because he had financial troubles in the past. So we're
like a property manager when you were telling them that, like, here's the property info, but this guy over here. So you were acting as what there?
I was the trustee of the trust, essentially. And so, yeah, we formed a trust that sounded very close to his previous entity. So it really didn't catch their attention.
That's what we do. Yeah.
Yeah. And then from there, I was basically added as just a contact on the loan, so I could get any information and give any information. And from there kind of said, well, the guarantor on the loan is trying to get his financials straight. We can't get you a personal financial statement or a tax return yet, but we just kept buying time on that. But we would give the annual property financials that they were requesting, which was a rent roll and a P&L and things like that. Now, I will say that's a risky deal when you've got a multi-million-dollar loan that may get called due. The risk was worth it because we weren't on the loan, number one. And number two, the capital partners that we had for that deal knew it going in that, hey, there might be a capital call on this deal, and we may have to come up with an extra couple $1,000,000 within a 3 to 6 month period to get it paid off, and they were comfortable with it. It's a, pretty scalable partner of ours. So we went into it eyes wide open, knowing that there was some potential default risk.
Yeah. Super cool deals, Mario. So I don't forget, tell these guys how to reach you. Any social media, direct contact, website, etc., whatever you want, because they're going to meet you live when I sit down anyway.
Yeah, I mean, the easiest way would be mariodattilo.net. That's kind of got links to everything that I'm doing, all my companies, podcast, which you've been on my podcast, Chris, twice. You've actually been on my podcast twice. But mariodattilo.net, and I'm on all the social media platforms, including YouTube. Just Mario Dattilo, you'll find me.
Yeah, and then your show, title of your show, so they can go find that and subscribe.
Yeah, MarioDattiloShow.com. It's the Mario Dattilo Show. And if you go to the MarioDattilo.net, it's got links to all that, including my coaching program, which is GetRealCashFlow.com if someone's looking to invest in mobile home parks.
Love it. Let me ask you this about the market. You mentioned market earlier, and you and I both lived through the lovely 2008 lessons we went through. Give me your thoughts on the market now. And I know you and I aren't billionaires and we're not economists, but I'd love your opinion.
Yeah, I would say that the market has definitely softened. And what I'm seeing is sellers who are selling right now need to sell. Investors who don't need to sell are just waiting. They're riding out the interest rates and kind of the big question mark in the economy. But people who are coming to the table right now need to sell. And that's a good thing. For a long time, there wasn't a whole lot of motivation and there was a lot of buyers chasing deals. So there's just this huge competition that you had to deal with. And, right now we're getting more off-market deals. We're getting more conversations about seller financing and creative structures. Like right now, we're actually talking to a seller about having them sell to us. We would go in and buy out a percentage of ownership in the deal. We would use their equity to bring in new debt, essentially. Let me rephrase this. Instead of buying the property out completely, the seller's in a situation where they've moved out of state. It's a pretty sizable community, so they can't really manage it effectively anymore. They've got some tax concerns, and they're really focused on cash flow. And so what we said is, look, why don't you stay in the deal? We'll buy out 40% ownership in the deal. We're going to use the property to leverage with a loan Okay. So we're going to then take that debt, take the cash that we refinance out with, and give that to you to buy out our 40%. We're going to take control of the entity. We will be the manager. You won't have any voting control. You will have some exit approvals. If we sell above we have to sell above a certain price without your approval. I'm sorry, we would have to get approval if we sold below a certain price, but they're staying in the deal as our partner, and we're using the asset, the property, as collateral to borrow against it to get the cash to pay them off. So, I mean, just some really creative things that you couldn't do the last few years. I would say that interest rates are a challenge, and banks are definitely, a little bit more conservative on business plans and turnaround plans than what they have in the past. They're also looking more at in-place cash flows versus, future cash flows in those business plans. We've also seen a little bit more demand on liquidity. They want higher liquidity amounts for the investors, meaning us as the sponsors. So lending is tightening. Sellers are getting more motivated. We're also seeing a lot of the institutional investors on the sidelines and more entrepreneurial, smaller investors kind of jumping in there and buying more distressed deals.
Well, I hope this screams loudly to the Wicked Smart listener that any asset class can be bought and has since the 1600s with creative financing. This isn't new. I get a kick out of Mario when I hear a Wicked Smart community member or a seller, for that matter, go, "Oh, I never heard of this." I'm like, "Are you under a rock? Like, what's going on here?"
Exactly. And I think, being a part of your program and your whole ecosystem, people are learning creative strategies that are great solutions both for the seller and the buyer. I think a lot of times people go into these deals like, how do I get the seller to do this? No. Yeah. You got to look at it from how do you solve their problem,
100%.
Utilizing these strategies, and you both win. When I go to a seller and I say, "Hey, look, why don't you carry the paper on this?" I never ask them to. I ask them if they need me to.
Yeah.
Because I'm doing them a favor, because I can go get a bank loan. Like, I'm bankable. Their property, or they might not be in a position to get cashed out. So I think it's framing and also looking at it from a mentality of how do you help them, and then they'll want to do it. You don't have to sell them.
Yeah, no, it's perfect. Solutions. Mario, let's flip to the students in your world. And I'd love to know, like, if you were to look in with a kind of a 10,000-foot view and go, "Yeah, Chris, this bugs me. This is something that I see people slowing down with or stumbling with, or the mistake they always make. And if they could just remove such and such, they'd cruise." Does something come to mind when I say it that way?
Yes. Like, what's the biggest holdup for newer people in the space?
Yeah.
I would say it's analysis paralysis. Yeah. So they're afraid that they are missing something, and so they just keep reanalyzing deals and overthinking it. Okay. I also feel like people get heavy into the administrative side of things. I need a website. I need business cards. I need, all these different things that aren't that important to buying real estate. What they need to be focusing on is marketing, talking to owners and making offers. All the other things, good example. A lot of times people are focused on, what should my entity structure be? Should I use an LLC or an S Corp? And should I have a holding company? And should I use trusts and all these different complex ownership structures? And I'm like, no, you need to find a deal. All of that can be put in place while you're in your due diligence process to find your first deal. But why put all of this in place? Find a CPA, find an attorney, all these different things. If you don't have a deal to work on, you're just spinning your plates and you're just distracted from what actually matters. Finding that first deal and getting under contract on it is the absolute most important thing. One thing that we do in our program is we make sure that students don't wait to get through all of the training modules and everything to start looking at real deals. By module 2, they're actually looking at real deals and analyzing real deals while they learn all the details of mobile home park investing, because what we found is when people wait, they watch, 15 modules, which is sometimes weeks for them to get through.
Yeah.
It puts them into that analysis paralysis. And the truth is until you start looking at real deals, you don't know what you don't know. I mean, you or I can create tons and tons of content about how to do things, but we can't come up with every single scenario that someone's going to run into. So once you start looking at real deals, that's where the good questions start coming up, and we can actually start answering those, and that's how you learn. So
yeah, that's fun, interactive coaching, right? That's what I call it, because that's exactly how you learn. In the trenches, interactive, with you on this shoulder or me on this shoulder. Yep.
Yes. Yeah. Once they start looking at real deals, then they can start asking you, hey, I don't understand how this works. And that's how you get the big picture. Yeah, training is important because that gives you the foundation, but ultimately getting into real deals as quick as possible and just bumping your head and wasting your time on crappy deals, that's how you learn,
Yep. Bang the head a few times.
Yeah.
Mario, super, super cool time with you. Is there anything as I wrap up that you wished I asked? I always like to end with that because I'll get off a show on occasion and go, oh man, I didn't get to talk about such and such. Anything you want to add or any nuggets?
I would say that a lot of times investors want to get into real estate. But they say, I don't know what I want to buy, like what type of property or what strategies I want to implement. How do I figure that out? So what I always tell people is first, think about where the economy is going, right? Come up with your own investment thesis, right? Is the economy going to be really good in the near future where people have a lot of extra cash and they want luxury items, or is their wallet going to be tighter and they're going to be more financially, conservative to where they're going to be trying to retain their money? And once you determine where you feel the general economy is going, start thinking about properties that are going to benefit from the economy that you're going into, not that you're currently in. So, for example, if the economy is going to become wealthier and people are going to have more money, then you probably want to be in luxury assets, Class A properties, right? Class A office, retail, residential, apartments, whatever. If you feel like people are going to be struggling financially, then you're probably going to be looking at Class B and C apartments. You're going to be looking at mobile home parks. You're going to be looking at self-storage. You're going to be looking at certain property types that do well when the economy is struggling. So that's kind of the first thing. Figure out what property type. And then from a strategy standpoint, it's really just being well-rounded. And that's where I think your group is very good at educating people on being a well-rounded investor. Don't go in and think that you have to go get new debt, that you have to just buy it and put a down payment down. So I think by being well-rounded, you're going to look at each deal independently. But ultimately, think about where the economy is going. Think about what assets, what properties do well, and then position yourself and buy those property types. Cash flowing versus flipping is another thing. Wholesaling. Decide what you're in it to do. Are you trying to retire? Are you trying to create passive income? Well, then buying and holding is going to be important. If you're trying to just create large lump sums of cash to be able to buy things long-term because you don't have the down payment, then flipping and wholesaling is probably the strategy that you want to take. So ultimately, know what you're there to do and figure out where the direction the economy is going and position yourself properly.
Yeah, smart thinking and getting ahead of it, right? It's so simple, but super effective.
Yeah, I think a lot of people, Chris, say, what's the easiest way to get into real estate?
Yeah.
And they go, wholesaling. Nothing wrong with it. Wholesaling's great. But it might not fit the business model or what you're trying to accomplish, and what you're wholesaling might not be the right property type for where the economy is today. Yeah. So it's stepping back and thinking through some of that before you start going down the road. Great thing is creative financing can be done with any property type.
100%. And I always say, and I don't want to step on toes because I know a lot of great wholesalers, right? As do you. Yeah. But a lot of people try to leave the W-2 and they go into wholesaling and they get another job because it's transactional. So anyway, I will put on that more than I always do. Mario, super cool to hang out with you. I can't wait for June 27th to hang out again. And we will put, Wicked Smart listeners, we will put all of the links that Mario mentioned in the show notes. And I encourage you to get a hold of him, get a hold of his material. It's Class A. And we'll see you on June 27th. Mario, same with you. We'll see you on June 27th, buddy.
I'm looking forward to it. I'm going to bring a special free gift for everybody to that as well. So make sure you're there. Take care.
Sweet. See you then, buddy. Okay, Wicked Smart listeners, that wraps up our time together today with Mario. Reach out if he can be helpful in any way. And I wanted to make sure, as I've been doing in all these shows here for the spring and summer, that you get a 50% ticket to our QLS live event. It's the annual. It's been taking place since 2016. But I want you to have a 50% off ticket. Go to smartrealestatecoach.com/QLSlive.com. And when you go there, use the coupon code podcast50 for a 50% off ticket. smartrealestatecoach.com/QLSlive and use the coupon code podcast50. Make it an outstanding week, guys. We'll see you at the event. I can't wait to meet you in person.
Thanks for listening to the Smart Real Estate Coach podcast. If you're ready to invest in yourself and take your investing to the next level, check out our 90-day Jumpstart program by going to smartrealestatecoach.com/jump. That's smartrealestatecoach.com/jump, because now is the time to act boldly in this unprecedented market shift.